All right, welcome to this episode of Real Estate Chat with Jonder Perez. And
Robert Eid.
that's right. And if you watched our previous episode, we made a bit of a boo-boo, computational error, data error, and we hold ourselves accountable. And as much as Real Estate Chat, we are very transparent with the information that we present, and we cite the sources. And of course, we're relying on the accuracy of the information. Robert holds himself very accountable to the forecast that he's done. And if you've watched any of our past episodes, and if you've liked, subscribed, and have interacted with us, you'll see that he's pretty much right on with the forecast for sales, for prices. But there was a major hiccup last month. Robert, what was the reason for that? And why did sales, we're going to talk about why sales shot up even higher than what you had predicted, but there was quite a big margin between the forecast of sales you had predicted and the actual number of sales.
True. Traditionally, like for years and years and years, I've been doing this. And since we've been doing these little broadcasts and everything and talking about it in the office, I'm normally within 3%, often within 1% on predicting the number of sales, often in the halfway through the month. Anyway, so I use the same method all the time. I have the Toronto Real Estate Board. I've had a set a search with parameters set up. And so I use it so many times and it was so good that I never check it. So starting in May, I started to get very low results. And I thought I was onto something because I'm the only one who's watching the stats on a daily basis. So I was using the last update as a time field between the 1st of June and the 1st of July. And I did it for freeholds and I did it for condos together and separately. And the reason I did it using that field is so that I could select the last status that I wanted, sold or sold conditional, because I was watching sold conditions for a while. But on the same screen, get both. And that was the way to do it. And so I could get these predictable results for all of everything and then condos and subtract and get the freeholds. All of a sudden, it didn't work out. I was off by half. Half is huge. 50%, 100%.
We were at what did we 4, 5, 6, 7 versus over 9,000 was the final amount. Yeah.
Half. So I inquired at the board to Jason, and he says, no, if you use the way he was doing it there is to use sold entry date, which is, another field, except you can't do conditionals that way because they're not reported sold. So either I changed it in the beginning of May or at the end of April and didn't remember doing it. Maybe I was crazy or insane or something or other when I did it on 2 separate charts. Anyway, if my new method is to use the sold entry date from the first month, last month, it comes out with the regular reliable result that we always have had to play with, but no conditionals because you can't do conditionals that way. So I said somewhere in the midst of this talking about the terrible low number of 4,000, 5,000 sales that someone was have egg on their face, and it turns out it was me. So, we rely on computers, we rely on input, but what we find out, just like with this nonsense about ChatGPT, a bias in or garbage in gives you the same biased or garbagey result.
And it's basically, what you kind of want to see is it's also confirmation bias, right? So what we want to see is kind of what ends up with the result where we should have caught it. I mean, myself.
That's the key point, is how come if I'm so smart that I was tricked into believing it? And it's because I thought the market was overshooting. And this was now a fact that confirmed my previously conceived notion. So, as I said to John the other day, I'm out of the predicting business.
Well, the interesting thing that comes out of this is the resilience of the market, right? And so we can look at the headlines of the market crashes, and there's entire social media accounts devoted to the Canadian housing market crash or the US housing market crash. And despite that, if Robert's predictions using his methodology would have turned out, that would have been a drastic change in the shift of the market. But the market is going on continuously resilient. And so let's look into some of these charts and look at the actual results. And maybe we'll try to coax Robert into forecasting for June now that his methodologies have been tweaked and have been improved with, I guess, some of the new technology, well, not even technology, but the criteria that's happening with the board. So what are we looking at here in terms of actual sales, and how come, from the prediction or the forecast rather, it actually it overshot?
No, it didn't overshoot anything.
Yep.
Okay, we're still 2.72% below the 5-year average.
Okay.
And we're still below 7.75% below the 10-year average. Now that pink line there is before you adjust for the lousiness of the lockdown. So that's why it's between those two lines. But the math is, let's call it 3 to 8% below the average. Okay, so it's not spectacular, but whoa, it's much better than being off by 30 or 40% from the average that we were earlier in the year, or all the way up until last month we were 20%. So that was pretty good. Now we're less than 10%. So it's almost an average year in a time when it shouldn't be an average year. It should be a lousy year. So it's fantastic. Everything is compared to what?
Well, considering that they've raised interest rates this week, another
Yeah, I
25
think people were
basis points.
anticipating that and
Yeah.
trying to get ahead of that.
And so
And
essentially the expectations are already priced into the market is what we're trying to get at. So let's have a look at this comparison for over the previous 3 years. And there's a clear pattern here in terms of where sales are going.
okay, well, this is the Trebs internal bar charts, and they put 3 years plus the current year. I added the line because when we compare sales to a year ago, it's maybe artificial, like it should be. When we look at the other chart where it was huge and then seemed terrible, and then it fell down and now it seemed better, like we're on an upward trend, and good for us. It's not a boom year. We've established that it's a subpar year. It's maybe 75,000 units for the year, but very strong for May.
Well, also considering what has transpired in this upward moving interest rate environment, and all of the restrictions that have been placed on non-Canadian residents or non-citizen buyers and whatnot. And so when you look at where sales are going with this being not too bad, would it be fair to say, Robert, that there is confidence in even this market?
It's a panic. Okay, it's as everybody has been saying, that there's not enough listings. And since there's not enough listings, there's like 30 or 40%, 30% off of what there should be for listings. But there is a 30% less supply of buyers. And they are saying, I want to buy something. And they want to buy something, except they find half the listings when they come out on MLS, you can't buy them that day. The owner is put it out at that price, but it's a fake price. He doesn't want to have offers for 7 or 10 days. And then he wants to have a bidding war. And his real expectation is 7, maybe 17% above what he's asking. So those inventory aren't really inventory because of the technique of low listing and selling high that's being employed by almost everybody.
Exactly.
Anyway, so the next
Let's
one
look at this.
is we are seeing now the percentage of houses over $2 million eking back up to the time when they were perhaps influencing the price. It's not quite there, but it's definitely up over the average. You see the two-year averages running along parallel, the two averages 3-year and 5-year running along, and we're way above that. So part of it is back then in 2021, the average price was lower. Now there's more houses that are worth $2 million and are selling for $2 million. Everything is selling. There's not one thing that's not selling, except for bad location, bad condition, bad price. They're not selling.
And so in a nutshell, these are pulling that average price up. So when you see that the year over year price growth for May was only a dip of -1% and change, we've got to look at how many higher price listings have caused that to be pulled to that figure.
Okay, we'll look at that. We'll look at that year over year artificial compare, because ones are crashing down, ones are going up. And so that we
We're gonna look at it.
we can't look at a year ago.
We'll have a look at it. So
So
let's
this
look
is
at average
this is
price
the
and how
same.
prices.
See, so you've got year ago and it's tiny bit down as it shows the orange to the black in May, but it's up every month since January. We're 15% up from the results we reported in January as the average price. So it's not a BIP of 1.2. It's up 3.71% from last month. The month before that was 4.3% up. So it's you would expect that in the spring. You're supposed to do that in the spring. But this is why the slice of time that you look at is just as important as the numbers that you use.
And what's going to be interesting is that, there's a few more interest rate announcements anticipated, and there is at least a chance of another hike happening perhaps in the summer. And typically prices dip. If you look at the year over year charts, seasonally, no doubt it'll dip in the summer because that's what naturally happens. But should we expect that this is just stable for the rest of the year, Robert? Will we end up roughly in this 1.1 something range?
Okay, go to the next one. Go to the next one. So here's no, that's two. What, back one? Okay. So here we see where we're sort of intersecting 1 point something or other year difference between 22 and 23. So 22 was an aberration. 22 was an adjustment year. 22 was a blow off and a reaction and a who knows what. Pretend that 2022 did not happen. And if you can ignore that top line there, then you're seeing a very normal year following a very normal pattern. And so to answer your question, what will happen in the spring and what will happen in the summer, same as it does every year. But taking the math approach of what's going to do compared to a year ago, it's not quite right. So the next one is 2-year look. We're just trying to call the same attention to the same fact. The one in the middle with the stars of purple is the year. It's a school year, so it starts in September, goes through the Lopheim, and then we're halfway through with our coinciding spot up there. And then what do you expect it to do next? Not quite as bad as the red line, but something like the black line, something like the yellow underneath. So normal, approaching the average number of sales each one of these months in the future. People seem to not care. I don't know whether it's a flight to tangible assets, whether it's I don't care what the interest rates are, I'm going to buy myself a house because renting is crazy. Whatever the factor is, people are not afraid as we predicted, and sellers are not selling. They're saying, grandma's not selling is my phrase. If I don't have anywhere to go, I don't want to go into a nursing home at $7,000 a month, so I'm staying here. And that's why we don't have inventory. Grandma's
Is it an adjustment in the perception of what reality or what the new normal is? Because in this interest rate environment, no doubt mortgages are higher, renewals are coming in higher, qualifications are a lot higher requirements. And so for price to grow normal in terms of these patterns, seems like it's an anomaly unless everybody just said, hey, you know what, this is what it is. And we all know that this spike that happened here was because of low interest rates and because of the pandemic buying and, scarcity and FOMO and all of these factors in, because this is the anomaly here. So, Robert, should we be worried that this is happening, or is this just going to be the way it is? It's going to be, every year is going to be like this now, normal.
Well, interest rates are going to be higher than what everybody thinks. 4%, 5%, 6% is going to be what you pay if you have A credit, B credit, C credit. And they're going to be higher for longer, just like they were lower for longer. The war that's being conducted against inflation is failing in the States and here because they're not addressing the tax price increase in fuel, which goes through every single item, reduce the price of gas, and everybody's heating bill goes down, everybody's driving costs go down, the cost for all the producers go down, the cost for all the transportation goes down, the cost for every grocery goes down, because there are people who are deathly afraid of climate change killing us in 5 minutes. And instead, inflation is going to kill us in 5 minutes for sure, unless they change policy.
It's a lot
So,
of different factors. And I guess it's one of those, time will tell where the prices end up going next year if the interest rates continue to rise and if they hold or if they go down, right? So
well, they're
some of
not
the
going to go down anywhere near as quick as everybody thinks right now.
exactly. So the
But
earliest predictions were late 2023, 2024. There may be a
correct,
dip, but
correct,
we're still
correct.
going up.
Everybody's going to be disappointed and surprised and not like it, but there's nothing they can do about it because they're
Right.
so
Yeah.
until we get a glut of houses coming on the market, it's going to be just like this now.
Yes, sir.
Far stronger real estate market than anybody expected until interest rates hit, another point from now, and that may or may not happen.
Exactly. So
So
let's
this
look
is
at
the price chart. Now we don't even need to talk about that. There's too many numbers, too small.
Nope.
Just skip that one.
Skip for today. Okay.
Okay, so here we are with active inventory, which is a snapshot picture taken by the real estate board on the last day of the month, and we got 11,868 as the standing inventory on May 31st, which is about 31% less than the 10-year average, 17,000, and about 26% less than the 5-year average, 16,000. So there it is. There's not enough houses compared to normal. What people are looking for in the maximum time when they want to buy, there are a huge deficiency, 25 to 30%. So since everybody knows that new listings are the problem, the one thing that I've been harping on through this whole thing is, okay, I think that's one of the techniques that's being used by registrant members of the Toronto Real Estate Board is to take a listing that's not selling after 10 days, or their initial strategy of holding for offers they didn't get satisfaction is they terminate that listing, get rid of that history, put it through again, and it shows up as a new listing. It's counted as a new listing. The boys at the Toronto Real Estate Board say, well, it is a new listing. It's a different price. It's a different strategy. It's a new listing. But it's not. It's a rerun. It's the same broker, got the same owner with the same house, but they've changed the price. It's a price change. It's a rerun. Anyway, they don't count it that way, but they count it their way. They got a machine that counts it. And they said last month there was 15,000 new listings, which again is still light. We're still 10 to 17% below the averages. And they're saying that according to their algorithm that there was 1,612 duplicates. And that makes it even worse, is 26% below. But nobody cares. There's more new listings. And so well, this is where we can maybe even talk about all the experts that are getting information to CREA, making a report from CREA, Mr. Hogue and the lady from Bank of Nova Scotia, and puts a report based on the preliminary studies that come out, and it's announcing that here we go, influx of sellers speeds up Canadian housing market. Referring to an increase in the new listing numbers that's reported by the various boards. Now, I maintain that the board is helping solve this new listing problem by counting the duplicates as new listings. And I did a calculation. We can look at that maybe later. And so there's nothing wrong with an expert from afar relying on numbers and making a prediction according to all the economic models that always work and everything like that. Here you got an amateur who only knows about one thing and made a huge colossal boo-boo because he was relying on data that came from another source. So
Well,
you can't say anything bad about them.
Yeah, and when we link to RBC's article there, you'll also see that everybody's using different sets of data, different charts, different ways of modeling this. You're looking at seasonal adjusted, house pricing, home price index, and there's a whole bunch of different ways to measure these. And there's the averaging of average, like there's a ton of different ways of doing this. So the most important thing to learn from this, and Roger, in terms of Robert's charts in being able to, I guess, get a glimpse or get a insight into what's happening, is you got to look at reality, right? What's actually happening with these listings, why the inflated number of listings will affect the way you perceive inventory, and why, putting a whole bunch of these numbers in and then seasonally adjusting it and adjusting it that way, I don't know if that's necessarily the best way to approach it. And I mean, here, Robert, you go through calculations of this phenomenon to show exactly what the impact is.
Yeah, during two ago sales meetings, I came to me that how can I correlate the inventory at the beginning of 1 month, and then add in the new listings that occur and take away the announced relistings and take away the sales and take away the number of terminations that aren't relisted. There's just plain old termination. What do you come up with? And this, using the main numbers, I started with the 1037, then I added the 15,1, and then I subtracted the 1,612 and subtracted the 9,020 and 12 sales, and I've subtracted 2/3 of the terminations and got 13,815. However, the actual inventory in May was 11,800, so a difference of 1,947. So I believe that this 1,947 is the amount that the algorithm that the Trev is using to ascertain the number of relists is the amount that they are missing. And if the number of relists were 1,947 higher, that'd be like 3,500, 3,600, and that would be a significant 23% of the net new, not the 10% they're saying it's nothing to worry about. So I don't want to say it's intentional that they're deceiving people, but this mistake solves the problem statistically, even though it does nothing on the ground. Okay. So days on the market. Days on the market is days on the market, and you can see the charts all going down. Both the all the listings together for the same property added together have gone down to 20 days. And if you just the listing that was in effect at the time of the sale goes down to 14. So we're not down to 7 or 9 at the time of the crazy boom you can see at the bottom, but it's very good. You know, it's 20% below what the averages are. So this is what we know on the ground as well, that things are selling quickly and there's no conditional, very few are selling on condition. Maybe the condos are selling with a few days to examine the status certificate and get the final confirmation of a mortgage on it, but they're all firm deals. And so they're selling boom firm 14 days after.
And what's interesting to note here in the distinction between these is that similar with the terminate and relist, if you terminate and relist, the property days on market adds the number of further days that it takes to sell. So if you're looking at, I guess the average of the difference of these is only 6 days. So somebody
on a percentage, it's
sell,
huge. On a percentage, it's 50%.
Yeah. But if somebody fails to sell within a week or so, on average, they sell at the eventual price, which is what property days on market works out to be. But that's basically saying you list something, you fail to sell it, at worst, on average, it's going to sell within 20 days if you don't get it right the first time. And when you do get it right, it only took 2 weeks to sell that on average. So, yeah. Well, let's look at the active months of inventory now.
Okay, active divided by the number of sold. So the number of solds went up and the number of active went up some. So the net effect is we have 1.32 months of inventory at the end of May, which it's not the lowest we've seen of .5 and .6, but it's not sort of average, which we see around 3. And I think everyone would agree with that. It's not a wild time, but it's pretty wild.
Well, I mean, if this is the new normal rate that the market is going, it is wild because, I mean, again, for in layman's term, months of active inventory means that if no further listings hit the market, it's only going to take a month and a half for everything to get sold. And so at this peak time, it was less than like 15 days of no more listings being hit on the market. 15 days, everything would have been sold out. So a month and a half is pretty wild. Right. And, you're sitting at 2-3 months. I don't think we've seen like 2008 hit as almost 9 months. So this is, let's just say it's going to be very interesting what transpires in the next months, in the next year. Right. So.
And so sales to new listing is the last thing that everybody looks at. So the black line, using standard everything, according to what the board puts out, says that it's 59%, which is just a tiny shade under seller's market. And I'm sorry, the black line is my adjusted method where I've taken off the relists. So that's a 66%, which is in seller's territory. We very much agree it's in seller's territory. And the regular standard method says it's 59%, which is the red line with the black dot. And that is also on the top half of balanced market. It's
It's
I
an
don't like this.
AO.
I like months of inventory better than this
Yeah.
because there's two
Well,
variables.
Yeah, I mean, the months of inventory shows you in real numbers.
Yeah,
the
very
abs-
simple number.
What's the absorption rate? Yeah,
So here was a brilliant idea that we borrowed from the very same Mr. Robert Hogue of the Royal Bank, where we coincided all of the peaks of the last 5 booms, and our 2023 is breaking all the records and doing everything its own way and surging up. And so we'll see what happens. And as I said before, until there's a huge glut of listings that appear on the market, what's going to stop it? Nothing. So everything adjusted here. Prices move up from the boom. We can't see too much of inflation because it's only been haven't had enough time for it to take effect. But we watch this over 20 years. We watch this over 10 years. We watch this over 5 years and see how the depreciating value of the Canadian dollar increases the price of property. You can look at the charts. You can look at anything you want. But if you're a buyer, like I just had a fellow out at lunchtime here, and he's switched neighborhoods trying to find a decent size that he likes at the same price. And so he's looking at what would be considered poorer neighborhoods. But the poorer neighborhoods he doesn't like. He says the size is fine. I don't really like the building. I don't want to live in this neighborhood. So this is the search that everybody's on, and they end up either in Clarington or Guelph or some other part of town that they never imagined they would ever live. It's still going up.
it's the affordability thing, right? So prime real estate is prime real estate. And, if you're not here, you're looking at the outskirts, you're looking further out, and those places have boomed during the pandemic. Everybody thought that they would dip because of work from home being eradicated and phased out, and in some cases they are, but look at what's happening now. They still look affordable. And when you're looking at what options you do have in the city, which is GTA, Toronto proper, you're kind of tempted to move into these places where you're still getting detached homes in the 800, 900, don't bother you with even $1 million, right? So on that note, thank you for watching this episode of Real Estate Chat. And we're looking forward to hearing from you. If you like this, click on thumbs up. If you disliked it, click on thumbs down, but make sure you subscribe and make sure you watch our next episode of Real Estate Chat. See you next time.
Bye for now.
Bye for now.